All right, we're going to try to make this, fairly concise. We're going to go through 15, 16 slides, talk about some different charts, and then leave some time for Q&A afterwards. If you're not familiar with the Zoom Q&A, if you look at the toolbar, there is a Q&A, and you can type that in, and we will see it. And we'll be answering questions at the end. So thank you all for joining. We do appreciate your time, and we'll try to be respectful of that. So it has been a very volatile start to the year for sure. It's been a very, very volatile last week. Like I say, the title of this is When the Levee Breaks. We'll talk about the reason for that title here in a few slides. We're going to go over a few topics: market overview, talk about the Fed, go through some important S&P levels, look at potential outcomes, and lastly, look at some recent portfolio positioning for various client portfolios. So let's dig into it. You know, it has been a very tough start to the year. It's actually been the second worst start to the year since 1950 for the markets. And one of the interesting things about the way this year has started is that there really has not been any place to hide. This chart shows year-to-date performance of the S&P, emerging markets, bonds in the form of TLT, long-term bonds, FXI, which is a Chinese large cap stocks, the Russell 2000, and the NASDAQ. And everything is basically down about 20% so far. And this is not including today's performance either. This is actually through yesterday. So really has been no place to hide. And that's been the story of the year so far. S&P 500 index, if we focus in on sort of the granddaddy of the equity markets, we had, if you read any of our publications over the past few months, we have identified this 4,100 area as a very important area of support. And the reason we identified that is the market told us over the last few months that level was an important level to watch. In this chart, this is a chart of the S&P 500 since about mid-December. The red shaded area is the support area, kind of 4,100 to about 4,160, 4,170. And the markets tested this level multiple times. Right here, the very first green arrow, that was the morning of the Ukraine invasion. We saw it test a couple more times in March, saw a couple times in May. And then on Monday, we broke below this level on high volume, and it was about a 3.5% down day. So this is the levee that we talk about breaking in the markets. And this is we feel, a very big development that if the market is going to try to move forward in a positive level, it really needs to recapture this area fairly quickly. Part of the reason that this is broken down, and looking at some of the specific areas of the market that are the biggest weighting in the market, the story of 2021 was the performance of the top 5 or 10 stocks in the S&P 500. And so far, they had been holding up relatively well. They really pulled the market higher in 2021. This is a chart of Microsoft, Apple, Amazon, and Google. And these are the top 4 holdings in the S&P 500. Roughly how much are those, Chad?
Yeah, these 4 are about 20%. If you expand it out to the top 10, it's about 30.
Yeah, so we're looking at roughly 20% of the entire S&P 500 in these 4 stocks. And it's not a surprise that the S&P broke down below pretty critical levels almost right at the same time that a lot of the what we call the generals within the market broke down. So Microsoft broke down on Monday, Apple broke down on Monday, Amazon broke down about a little over a week ago, Google broke down a couple weeks ago. So, you know, where these really mega cap tech names have been doing the heavy lifting over the last few years, one big concern is that if these break down like they are, and they continue to break down, you know, with so much weighting in the S&P 500, it's going to be hard for the S&P to get any real traction higher if these big companies don't start moving higher as well. And we're seeing just the opposite. So that is a concern. And it does make us think that, we are headed into a bear market or are already in a bear market. And I think it's helpful to go back with history and look at prior bear markets. This is a chart from Ben Carlson, who has a website called A Wealth of Common Sense. And he looked at the various S&P 500 bear markets since 1950. And what we found is that the average decline was down 30.2%. The duration of the decline in calendar days was 338 days. So right under a year, about 11 months. And the time to break even from the start of the bear market to where it was back, recovered all of the price, was 1.7 years. And if we put the recent decline in context, so far we're 127 days into the year. The high was on January 4th, and we're currently down 16.8%, and that is not including today's move lower. So what this tells us is if we are in a true bear market, which we are leaning that direction now, we probably still have further to fall if we're going to look at an average bear market. Part of the reason, and probably the main reason, is the Fed. This is something else that we've talked about a lot over the last year. This is a chart from McClellan Financial Publications. The green line is the total assets held by the Fed, combination of mortgage-backed securities and treasuries. The black is the S&P 500 going back to 2006. And what we've seen is that these various periods, when the Fed is printing money and this green line is increasing, that's corresponded almost one-to-one, directly corresponded with a rise in S&P 500 prices. And when we've seen a flattening of this, where the Fed has paused printing, not even necessarily raising interest rates, but just looking at the flow of assets that the Federal Reserve is printing and flooding the financial system with, when they slow that down, we've seen periods of volatility. So in 2010, we saw the flash crash. That's right as the Fed stopped printing money after QE1. In 2011, 2012, we saw almost a 20% drop as the US debt got downgraded and the Fed stopped QE2. We saw a pause after QE3 where the market moved sideways. And when the Fed finally started to reduce the balance sheet in 2018, 2019, where the green line, the only other time the green line started moving lower is really when we saw a lot of volatility over a period of time. And if we look at the very top up here, the top right, we're seeing that volatility now, and the Fed just stopped printing. They haven't started tightening yet. So it very well could be that if we don't see a reversal by the Fed, which we'll talk about on the next slide, I don't think they necessarily can reverse. If they don't see a reversal, this volatility may just be getting started. Anything to add, Chad?
Yeah, the only thing I'd add is that the green line is what the Fed has officially announced they're going to start reducing starting in June. So they're going to start with a lower amount in June, and then they're going to double it by the end of the year.
Yeah, so we should be seeing that green line reduce. And if history was any warning sign, we should expect volatility to increase with that. And in fact, we already have started to see that. When we look at what the Fed is in a bit of a pickle, and we think they're stuck, we wrote an article saying that the Fed is stuck about 9 months ago, sort of mid-year last year, is that they're just well behind the curve. The tan line is inflation, year over year percentage inflation. The two-year yield is the blue line, and the Fed funds rate is green. And what we've seen is post-COVID, inflation has just consistently moved higher and has actually been above the Fed's 2% target for well over a year now. And the Fed waited 8-9 months before they started to increase. And it was really once the 2-year yield started to move higher that the Fed really doesn't have much choice but to try to raise interest rates. And at this point, inflation naturally has a downward pressure on demand. People at some point will stop purchasing when prices get high enough. The Fed, it seems like they want to accelerate that, and seems like they want to push the economy into a recession, which they may be doing. First quarter GDP came out negative, and I think it's a good bet that second quarter GDP is either flat or possibly negative, which would be a true recession. And one of the things we like to look at a couple things, say, okay, well, how much of this is priced in? We've seen a lot of volatility. We know that there's inflation. We know the economy might be weak. We know interest rates are going to go up. The Fed has telegraphed all these different things. So how much is priced in? What sort of panic are we seeing? And one of the things that we've noticed is that we really haven't seen a big washout yet. This is a chart of the VIX. And if we look at the VIX at 32 right now, the VIX started in existence in the early 90s. The orange dotted line is the current level of the VIX, and it's nowhere near where we've seen sort of these major bottoms for the kind of decline that we've seen. So it tells us that we might have a little bit more room for this volatility to spike higher in the near term. The other thing we look at, just look at breadth, and this is a little more complex chart. This looks at the number of stocks that are above their 200-day moving average. And a lot of people will look at a 200-day moving average, the average price of a stock over the last 200 days, that if it's above that level, that means it's rising. And if it's below that level, that means it's falling. It's below the average price over the last 200 trading days. And what we're seeing is 22% of stocks are above their 200-day moving average. That's pretty low. But again, the decline in COVID, the decline in the fourth quarter of 18, 16, 12, 2008, 2009, kind of every time over the last 15, 20 years that we've seen a decline of 20% roughly. It's gone much, much lower, about half of where it is right now. So this also tells us that we're not seeing a big washout just yet. And really the decline so far has been fairly orderly, which is, given the volatility, is sort of strange saying, but the data is suggesting that there really could be a lot more to fall. So what scenarios are we looking at? Obviously, how our particular investment strategy works, it does not care what we think is going to happen in the market, and that's by design. But we do think it's good to look at some different scenarios on what may or may not happen and what to look for. I would say this scenario one is sort of our best guess, our base case, if we were going to have a base case scenario. And what this would be is, given this breakdown of 4,100, it would make sense for the market to try to rally up to retest that level and then start to move lower. It doesn't necessarily have to retest it. It looked like it tried to do it a little bit yesterday, tried to get some positive momentum yesterday, tried to get some positive momentum today, but it keeps selling off sort of the second half of the day. So I don't know if it's going to have enough gas to quite get up there, but this would be a pretty textbook move lower, and I would assume that this down arrow might really start to get a little bit nasty, a little bit nastier than what we've seen so far. Anything to add there, Chad?
The only thing that I would maybe I can explain real quick kind of what this really means. And it's really just a supply and demand conversation. We're pointing out 4,100, but really it's the market that's telling us 4,100 is important. And it's because of what Jim mentioned earlier. There's those 5 tests of that level that means that traders came in at that level and bought, and they enjoyed success for a little while. And then now though, those buyers are all now, quote unquote losers, so to speak. They're now, what was in the money is now out of the money. So in this scenario, the thought is that those that were out of the money are looking to just break even or get out. So it's a lot of market psychology that goes into this kind of support and resistance analysis. But the thought is that everyone that bought above 4,100 would be happy to get back, even or close to even. That's why you go retest that level, and then it resumes its downtrend.
Scenario 2 seems like a little bit of an outlier, just because of some of the negativity out there with inflation and interest rates and things. Looks like we're just getting started on those things. But again, a lot of that could be priced in. And another scenario that we need to be aware of would be that the bull market resumes, that the breakdown below this 4,100 level would be considered a false breakdown. And if the market can recover this level here in probably the next 1 to 2 weeks, on some very strong volume, that would be a pretty positive sign. That's also the first level that we're watching as a place to start adding equities back into client portfolios, as opposed to reducing equities, which is what we've been doing the majority of the last couple of months. But we need to be aware that obviously a lot of different things can happen, and the bull market may or may not be over. And this is something to watch for as an early sign that the bull market could resume. Third scenario that we're watching is that we've seen a couple of these chop zones. We're in a chop zone here from 4,600 to 4,100, where we had this bounce around in this area for a little while. And what we could see is that it starts to find this and bounce around sort of maybe between 3,800 and 4,100, something like that. And we chop around for a few months. Maybe inflation starts to subside a little bit. GDP becomes in mildly positive for the second quarter. Earnings continue to be okay, but not great, not terrible. And we sort of reestablish a chop zone. So that's something else that we really need to be aware of as well. Last slide is positioning. Just want to update clients on how we're positioned. And what this chart looks at is 3 of our primary investment portfolios: a balanced, a growth, and an aggressive growth. The dark blue is our average target equity. If things are good and we're fully invested, what would the target equity exposure be, or target stock exposure be for that portfolio? And then what's the current equity positioning right now? So in a balanced portfolio, roughly 65% would normally be allocated to stocks. We're right at 26% right now. So put another way, balanced portfolios are roughly 75% cash and fixed income right now. So we've really de-risked these portfolios. Growth portfolios, which sort of target 85% equity allocation when things are normal and things are good, we're sitting at about 36%, 37% equity. So again, a pretty big de-risk. A growth portfolio, another way to say it, is 63% in cash and fixed income. And then aggressive growth, which can be all in equities, is currently about 62% cash and fixed income, a little less than 40% equities right now. Our guess for the immediate future is that this probably gets lowered even further. If the market continues to sell off, we are right around some stop levels on some stocks that our clients currently own. And it really would not surprise me if we saw a few more bad days, a few more 1 or 2% down days, that we could end up with 85, 90% cash and fixed income almost across the board. So we've definitely de-risked. For clients that are on the webinar today, you've probably seen, if you're watching your portfolio, you've probably seen a lot less volatility over the last few weeks than the first of the year. And that's because of this pretty massive de-risking that we've gone through, especially over the last 6 to 8 weeks. Okay, we were wanting to try to get this done in maybe 15 or 20 minutes. It looks like we did that, and wanted to leave plenty of time for questions. So I don't know if anybody has any questions. You can type it in. If you're not familiar with Zoom, there's a Q&A, and you can type your question there, and we're happy to answer it. Hey, Charles, how are you? I think you're muted.
I see a couple in
Sorry
chat
about
too.
that, technical difficulties. I'll go ahead and put my camera on. Congratulations on another good presentation. I did want to ask you, perhaps if you watched Warren Buffett last week or two ago, go through his Occidental purchase and his thinking about, well, him and Charlie Munger are questioning some of the trading that's going on in the market. And I just didn't know if that played into your long-term thinking or not.
Our thought, well, a couple thoughts there. One, we do think technology in general is having an effect on market prices, both in the global flow of information and the speed at which news is processed. And essentially what I personally think is happening is that it's adding more emotion into the trading environment. So we're seeing a sort of bigger disconnects from fundamentals when you see fast-paced trading and sort of retail trading where anybody can open a Robinhood account or TD Ameritrade or Schwab or whoever, and trade throughout the day. The access to the markets, the global financial markets, have increased. I think that's a good thing, but with it, I think become a little bit more volatile markets and a little bit more speed at which they happen. So whether it's a good thing or a bad thing, I'm not sure. But ultimately, we think that all of that is in the price. And that's one of the big reasons that we think that price is the purest data point that we have. And with these various levels, for example, like Chad said, those levels are important because other market participants have said that those levels are important because that's where buyers started to overwhelm sellers and the market started to move higher. So I think it becomes an environment where you need to rely on a little bit more quantitative and technical data in the markets, because I do think we're going to see bigger swings around. Companies are not going to be priced at their intrinsic value for very long. They're going to be premiums and discounts to those. Does that answer your question?
Well, it does, but if you want to follow up further, he specifically mentioned a trade for Occidental, and I was wondering if you had followed their charts, like Occidental or your energy company of choice, and whether you saw the charts backing up Warren's decision to buy Occidental, or whether he's made a bad decision. So he's also Apple's largest holder, I guess.
Yeah.
So.
He's made good decisions. He's obviously expressed. I think Warren Buffett, and I can't speak to his specific decision making, but I think he's making a bet that inflation is persistent, that we are entering into a non-transitory inflation environment, meaning that it's not going to be a 1 quarter or a 1 year thing. He's probably seen the challenges that some of the states and countries have gone through with trying to adopt clean energy a little bit too early, possibly, and thinks that the fossil fuels have a little bit longer. So the charts have been fantastic. Frankly, a lot of the energy charts for the most of the year have been tremendously overbought. and are kind of ripe for a fairly large decline. That's sort of the nature of the energy beast, is feast or famine. So, from a longer term perspective, yeah, sure, I could see oil prices staying high. I think the risk here is inflation gets too hot, the Fed gets too tight, consumers naturally slow down their purchasing habits, and we reverse from an inflationary environment to a deflationary environment because of a very weak economy. I think that's the risk near term to Occidental and energy stocks in general.
Mm-hmm.
And that's one of our concerns is this rapid inflation, causing everybody to tighten the belt. And we're starting to see that in some economic numbers right now, frankly. So,
and have you analyzed what's going to be going on with the grain markets, with both Russia and Ukraine, perhaps responsible for up to 30% of the world's supply right now? I mean,
yeah, I mean, that's, again, we think everything will show up in the price.
mm-hmm.
And if we're talking about it, that means the major traders in the agricultural commodities they know about it. So that will show up in the price. And that is one of the concerns, is the food inflation, just purely out of scarcity, from supply chain bottlenecks, from the war, things like that.
Mm-hmm.
Hey, if I can chime in real quick, and then we've got a few other questions
Yeah,
too.
we do have a few other questions.
The interesting thing to me on the commodities, you mentioned wheat and maybe you throw corn and soybeans in there. You look at livestock, it's actually down year over year. So cattle, pigs, things like that, which I find extremely interesting, because there's all this focus on energy and wheat, but those are big inputs to cattle and pigs. And so I think you're seeing, if you really dissect the commodities market, you see a few headliners that are flying really high, but then there's a lot of other commodities that are not showing near the bravado that the other ones are. So, I think it's kind of like equity markets too. You dig down to the next level and you can find certain different areas that are doing completely different things. And commodities is one of those.
But great questions, Charles. Thanks for joining us today.
Thank you.
Couple other questions I'll go through. One question from a client: how much more does the market have to drop before our plans will not work? This is probably the biggest question that we're focused on. And for the clients on the call, and maybe who are on right now and who may listen to the recording, the kind of volatility we're seeing right now is fairly normal volatility, frankly. The market experiences a 10 to 15% decline on average 1.1 times per year since 1928. So, for most of our clients are kind of in that down 11 to 15 or 16%, depending on how aggressive they might be in the timing of getting in with us. And those, the declines that we've seen in client portfolios do not cause us any concern for any of our clients to have to restructure their financial plan. And as a firm, that is one of our major goals. Our first goal with managing money is to remove the big declines. And the slide where we talk about the equity exposure, this is how you do it. You have to get your portfolio out of the way of the big market declines. The first 5 or 10% are really tough to avoid. Those declines are tough to avoid, but from 10 to 20% is when our strategies start to see some more major outperformance. And if the markets are down more than 20, are typically when we're mostly out. Right now, market down about 17%, and we're 25 to 38% equities. So we've really de-risked the portfolios a lot. So at this point, we have no concerns that the volatility that we've seen and declines that we've seen in portfolios are anywhere close to having, causing any kind of long-term concern with regards to financial plans. and we model that in our plans as well. We model 20-30% downsides that happen over time. So we're well within those tolerances.
And I can add to that along with another question. It came from our chat from Peter. Where are we putting new money to work? So similar to the commodities, there are parts of the market that are holding up still. And if you look at the portfolio we have today, there's consumer staples is one, and consumer staples are your Walmarts, your toilet paper, your paper towels, those kinds of things that you use every day and you'll probably use no matter what happens with inflation or a recession. So there are parts of the market that is still working, values performing better than growth. So, our signals are designed to kind of find those pockets of the market where things are actually working, at least for the time being, not to say that they will always work. And those staples might also, resume, in a bear trend. So, but currently that's where we're putting new money to work, is these areas of the market that are working a little better than, your broader market and what you're seeing in the headlines.
Thank you, Chad. Another question. Do you think an escalation of war in Ukraine would create further bearishness, or would you expect more support because of maybe a Fed reversal in policy? It seems to me that the market has quit really responding to developments in Ukraine. Obviously there was a big initial negative reaction, and the market was moving. Anytime that Russia would move into a different city or take a little bit more territory in eastern Ukraine, the markets would sell off. But really, after about the first 2 or 3 weeks in March, the market sort of put that on the back burner. So I do think that that's a really tough question to answer. It's a very good question. I don't think that the market is necessarily pricing in escalation. I think they quickly shifted to inflation in the Fed. So if we saw, I think this is again the pickle that the Fed has gotten itself into. If we saw an escalation of the war in Ukraine, I could see that further damaging. Or the other thing is a aggression by China through Taiwan. That could even be a bigger unexpected geopolitical development globally. But I think the risk there is that you get further supply chain disruption. You get further, like our Charles said, further maybe grain and food agricultural dislocation. And that would potentially cause higher inflation. So what does the Fed do? I just think the Fed is really stuck right here. I think the Fed is hoping that inflation goes down. I think they're hoping that interest rates go down. But I think we've always said hope is not a very good plan. And I'm not sure what their plan is going to be. I think at this point, it's going to take quite a bit. I think they've come out and said they are focused on inflation, period. And previously they were very much, they want to support the overall economy, support maximum employment, have the inflation at the 2% target. But really over the past 3 or 4 or 5 months, they've said inflation is our goal, and they may not come back and support the markets. So I do think that an escalation of the war could very well cause an escalation of prices downward.
Yeah, I agree with that, Jim. And the Fed has 2 mandates: inflation and employment, right? And so until we see 1 or 2 of those start ticking, the other way, then it's hard to suggest that the Fed's going to stop here. I think they've realized that they've gotten away from those 2 mandates a little too much, and they're now having to really focus on it. Right now it's inflation. If we start seeing unemployment tick up, then maybe that'll give them an excuse to start, slowing down again, and or maybe even loosening but we're far from there. And you can't do that unless you have inflation fall also. So if you've still got inflation high and unemployment's ticking up, then I think they're still maybe even more so in a pickle.
That's right. Another question, looks like the last question that we have so far is asking about the fixed income markets and kind of thoughts on the fixed income markets. Again, we've seen massive declines in yields. For the last few years, we have been pretty hesitant to put on duration in portfolios because we do think that these interest rate and inflation cycles are historically they're 30-year cycles. Going back to the late 1700s, we typically will see a period of rising interest rates and inflation that lasts about 30 years, followed by a 30-year period of declining interest rates and inflation. And the current period of declining interest rate and inflation started in 1982. So we're about 40 years into a 30-year cycle. And I think that could be part of the reason why we're seeing interest rates move up so quickly. It's trying to catch up to that cycle. So we've seen, the 2-year treasury went from basically 0 to almost 2.7%, 270 basis points in 6 months. And that's kind of wreaking havoc across the financial market. So we think you should expect volatility in bonds. We think you should expect volatility in stocks. That's why we have cash as a major part of portfolios right now. That is the one place that is non-correlated. When you see a chart like this, where everything goes down, cash didn't, or the short-term cash equivalents that we use are just down a little bit. So, fixed income, I wouldn't get super excited about fixed income yet. We're probably going to see some rallies there, and we're going to see some opportunities for some shorter term ways to exploit maybe a shorter term decrease, decline in yields. But at this point, it's really just about trying to get into places that are working and reducing overall exposure, kind of reducing beta in your portfolio so that we can really start to reduce and eliminate the downward moves in portfolios. And at this point, we just view that as being cash. So, well, it looks like that's all the questions we have for today. I would like to once again say thank you to everybody who joined. We're going to be sending this out via email and on social media, the recording of this webinar. We're going to do that tomorrow. So look for that. It will not require a password or passcode. We did that to avoid potential spammers coming in and asking some questions. So we appreciate your time and attention today. We appreciate the questions that you had. And we also very much, to all our clients, appreciate your business and trust. And we will see you next time. Thank you all. Have a great day.